Welcome to Investing Confidential, where we try to give you the signal, not the noise. Wild day today with the markets, but I'm going to concentrate on what's going on in the oil markets because I think this statement this morning by one of the Biden officials was actually staggering. So as we know, the Biden's going to come out and talk about releasing more strategic oil reserves. I mean, think about it this way. When they came into office, it was over 600 million barrels. Now we have 400 million barrels. 15 million is a kick in the bucket, but they're going to release a lot more, as they said, through the winter. So we could have a situation where, as during, in the first quarter of 2023, we could have the strategic oil reserve, closing at 300 million barrels. I mean, half of what it was, 2 years ago. This is insanity. Then you have one of these officials saying they're going to buy back the oil at 70. I mean, how crazy. I mean, no trader or no investor in their right mind would publicize their selling and buying levels. And I'm talking about of a large size. Imagine BlackRock telling the public what they're going to do to a certain stock in the market. It makes no sense. So this whole thing that's going on in the oil market with the White House talking about depleting strategic oil reserves and then buying back at $70 a barrel. What this all means is oil's going higher, guys. Higher. Significantly higher over time. If this continues to be the policy of the government, oil will continue to go higher. And who does it help? Helps Russia. Look at their current account surplus. Look at this number. This is like Switzerland in terms of, so a current account is like your balance sheet, is like, how strong you are as a country. And look at this, Russia, we're just making them stronger and stronger. Not their economy, but the government itself. Now, because of all this excess capital they have, they can go out and stimulate their economy and do things that no one else could do. They don't have to print money either, by the way. They can keep their currency stable, and it doesn't make any sense from a policy standpoint. Russia is run by a maniac and should be stopped, but that's a political thing. I'm not getting involved in that. But right now, the bottom line is we are making them stronger, not weaker, by this policy. I want to mention something that came out on the investment banks. We had Goldman Sachs reporting yesterday. Look at this. Look at these results by these investment banks. This has been a disaster for them, okay? They report bad numbers, but the stocks go up. Their investment banking business is falling apart, okay? They're down 40, 50% levels. That's unprecedented, these moves. When we talk about that side of the business, look at the IPOs. IPOs have collapsed. There's no more IPOs. 75% of these IPOs that came out that were pushed on the investing public are below the IPO price. We're all losing money. When you look at this situation, and it's not just stocks, it's the bond market. There's no bond offerings. No one wants to take new bonds when rates are rising. There's M&A is disintegrating. Private equity is having issues. So all of these issues are combining to really hit the banks very hard. And I think this is secular. Okay, secular trend versus cyclical, right? So cyclical means it's going to come back. I don't think this business is going to come back for them. I think these banks are in big trouble. Technology and other things have taken away their margins. Now you've got the volatility and other things. And when in a rising interest rate environment, which is going to be with us for a very long period of time, their business is collapsing. Okay, end of story. Look what's happening now. We're in the middle of earnings season, or actually just beginning to hit that really peak part of earnings season. What are you seeing is this: the Wall Street earnings. So these analysts were just out of control in terms of their estimates in the second quarter. Then they all, when the crap started hitting the fan, they went and just lowered their estimates dramatically. So now the companies are coming out and they're beating the estimates. They're weak estimates. These are weak beats, and their stocks are going up. It makes no sense. Absolutely no sense. I mean, you look at certain situations like Netflix, for example. They did come back and bring in some more subscribers, but they're low quality subscribers. And then they talked about having a low end thing with advertising So these are this is a low margin business. So the growth has stalled. Now you have a low margin business, and the market shouldn't be celebrating that. They should be very worried about Netflix going forward. But look, again, it's all about, short-term beating estimates, and it sort of makes no sense. We got Procter and Gamble again. They had numbers that were not good. Were affected by the dollar. The stock went up because they supposedly beat Wall Street estimates. And Wall Street estimates, by the way, are garbage. You shouldn't pay attention to them. Look at Tesla. You have to be worried about some of these companies. Tesla is going to report probably good numbers. Again, backward-looking numbers. All these earnings are backward-looking. Going forward for Tesla, you've got incredible amounts of competition from around the world with EV. You've got their big market in China that's depressed. You've got Europe was depressed. You got every consumer around the world has no confidence, right? Consumer confidence down around the world. So big ticket items like Tesla, I'm sorry, but I just don't see Tesla's a great company, but moving forward, holding this multiple they have is just going to be very, very difficult. But the one you need to watch on earnings season is Apple. Apple's going to report numbers. They're going to probably report, again, everyone's reporting beat. They're going to probably beat whatever Wall Street estimates there are. Again, they don't mean anything, but it's really the guidance. Apple has big exposure to China. They have big exposure to Europe. They have big exposure to currencies outside the dollar. You've got people around the world that consumer confidence is falling off a cliff. Apple sells big ticket items, so I don't care how many new iPads they come out with, new iPhones. It's going to be very difficult, this environment going forward, for Apple to show the numbers they used to show. So just be aware, Apple is definitely a benchmark you want to watch. And when we're talking about, again, consumer confidence, we have to talk about real estate. Real estate is driven by consumer confidence. Zillow came out with some warnings today, not officially, but unofficially. You had housing starts were in decline. It came out today. Building permits were down. Tomorrow you've got existing home sales, which can't be good, but it's just the beginning for real estate, right? So you got, home builder optimism is falling off a cliff. Home builder traffic, which information supplied by Redfin and Zillow, home builder traffic has collapsed, right? Mortgage rates are 7%. I discussed why that really has little to do with the past real estate bubble, has a lot to do with the going forward if we're going to recover, which we're not because rates are too high. And you've got to look at the fact that all of this is about the consumer. All of this is about going forward. Do you feel comfortable affording, or can you afford these prices? So you look at these statistics. Look at this mortgage to income ratio. This is extreme. So this is looking at the mortgage rate today versus the price of a medium home. Now remember, prices have not come down yet. They're starting to come down. Prices come down very slow. They go up very fast, but human nature, no one wants to lower their price. It takes time, a couple of years. You've got institutions, as I spoke about before, dumping houses on the market. It's going to happen sooner than I think, but it's going to happen over time. So the affordability ratio, the mortgage single ratio, something you really want to watch, is still at extreme levels. We've got a ways to go for housing prices to come down, especially the fact that I think mortgage rates are going to stay at high levels for a while. So really dire situation in the real estate market, and I just don't see any respite for it at this point in time. And this really comes down to inflation. As I mentioned in a few other videos, I think inflation has peaked, but it is very sticky, right? One piece of evidence recently, used car prices have collapsed, right? So that was a big component of the CPI. Used car prices, new car prices are also, inventories of cars is way up right now at almost at before pandemic levels. So any dealership, it tells you that they have a shortage of cars, just tell them to go fly a kite. They're all lying. It's all fake news. There's a lot of cars now. There's too many used cars. There's too many new cars. Prices of cars are going to plummet. Real estate's coming down. By the way, rents also, more fake news. There's too many houses. There's 1 million houses for rent. Rents are going to come down. So so all of this is going to contribute to lower inflation. But inflation is not going to hit this 2% level that the Fed is telling everyone. It's going to be sticky, 4 or 5%. Terminal rate's going to be 6%. That's where we're going to be, guys. 6%, 6 or 7% of the terminal rate, 5% on inflation, which is very high inflation. But that's where we're going to be before we get some type of fake pivot, which is coming. Let me talk a little bit about Bitcoin. I'm not a expert on Bitcoin, but I will tell you this. The thing to watch on Bitcoin is the volatility of Bitcoin. It's very low, very positive for Bitcoin. This is music to anyone who's bullish on Bitcoin. It should be music to your ears. You don't want to see Bitcoin all over the place. You don't want to see Bitcoin going back to 60,000. It may be nice, but if you believe in Bitcoin, if you believe the concept of blockchain and Bitcoin, or if you believe in technology and the concept of Bitcoin, you do not want to see Bitcoin go back up again to where it was before. You want it to stay low vol around these levels, and that will solidify what Bitcoin was created for. Read the white paper. Nobody reads anymore. Read the white paper of Bitcoin, and you'll see why the only way Bitcoin will become what it should be is if we continue with this low vol. And by the way, the rest of these other crypto coins go to zero. Okay, if you look at this performance of the top 50 altcoins, you're going to see now a differentiation of performance. You want to see the Bitcoins and the Ethereum continue to stay at these levels, but you want to see the other cryptos, thousands of other cryptos, go to zero. Bitcoin will never be what it is without these cryptos, because essentially, if you look at it this way, take a step back and say, why was Bitcoin so popular? Why did it make sense to a lot of people? Because people hated fiat currencies, the ability of central banks, and you can see them doing it today, printing tons of money. Whenever they need money, they just print it, debasing their currencies. Well, every time someone creates another crypto, that's essentially the equivalent of printing money. So if you're a bull on Bitcoin, what you want is to all these other cryptos to go away and Bitcoin to stand alone with a few others and keep the volatility low. That will bring more people in, more transactions, and that's the future, hopefully the future of Bitcoin. And I want to mention one last thing that I think is really important here that came out. First of all, tomorrow is a jobs number, so just be aware of that. You're going to have some more volatility. Again, I think these job numbers are eventually going to fall apart. I talked about that in other real estate, but job numbers tomorrow, continuing claims, jobless claims. Okay, so now let me talk about China. I don't know how much press this got. China delayed their GDP announcement. Now, I've spoken before that China's GDP, what the number is, it kind of like doesn't matter that much, but it's what the trend, what they're saying. But for them to delay this GDP announcement, especially the fact that where we think GDP, or the experts, which are around 3%, right? The experts think it's around 3%. China's indicated that's going to be around 3% in the past, recent past. But the fact that they've delayed this tells you one thing, that their economy is much worse, much worse than anyone expects. Because if it was 3%, 4%, they'd have put it out, no problem. The renminbi, as you can see here, is falling apart, right? Relative to its past, it's falling apart. You got this, and they're going to have to release this. Whatever the number is, it's not going to matter, because we know already by the fact they didn't release it, they're massaging it, and it's going to. So what does this mean? It means that the global economy is reeling, is in bad trouble. Europe is in stagflation. China is in some type of recession, a China recession, what we call it. And the U.S., we've talked about it. The U.S. already is in recession. Technically, the numbers, though people argue about the numbers, when the U.S. comes out with GDP, whatever it is, it doesn't matter. It's going to be very low. This GDP now, throw it out the window. It's more likely going to be 0.5%, something of that nature, very low, and then go negative again. So the three biggest economies in the world, the U.S., China, and the European Union, are staggering, right? Their economies are staggering. This is not a good, and then you have rising rates, rising inflation. You can't buy stocks. You can't. You can trade stocks, but it's very difficult to buy stocks right now in this environment. It is very, very difficult. So pick your poison. Try to find value. There is value in some other parts of the world. There is value domestically in small caps, which have very little outside exposure. They're not affected by the dollar, but is it a very difficult environment. So investors, be careful out there.